No, no.
So true to form, by the way, it's the first day of spring, right? So yesterday in the state of Michigan, on the last day of winter, it was 72 degrees. Today, on the first day of spring, there's snow flurries flying out my window. So um, in theory, it's
Yeah.
supposed to be getting better, but it never does on day one here. It's almost like Mother Nature giving you a little slap in the face and saying, hey, just kidding. You have to wait a little while longer.
Chris, are you going to go to the MMLA event in August?
Yeah, I'll absolutely be there. You gonna be there as well? Good. Yeah, that's always a great time. And I like the new venue they're gonna have for it too. Right in the center of the state. It'll be terrific.
Frankenfurter, or what's the name of the place?
Frankenmuth, the old modeled after the old Bavarian town, rich with history, and they just opened a brand new gigantic. I think it's like a 60,000 square foot water park there, indoor water park, by the way. So looking forward to that too. And the mortgage stuff will be great, but the water park's really what I'm kind of looking for.
I'll see you there with your rubber ducky and water wings on or
Yep,
something.
have a brand new speedo.
Yeah,
Good stuff. And
yeah.
John Barnes, right, jumps on that right in the chat. So good to see you.
I'm looking forward to seeing Chris in his lederhosen. So,
Rich,
Well,
before we get you started, by the way, from the last time you guys had me on 3 months ago, by the way, hearty congratulations to your Ohio State Buckeyes for winning the national championship in football. Hell of a finish to a great season. So congrats to you guys. It seems like the other times I've been on, the script's been flipped. So congrats to your Buckeyes on that win.
Thank you. And yeah, it seems like every time you've been on, it's just been in the wake of some horrific Ohio State loss to Michigan. So, yeah, better scheduling this time. And thank you. Yeah, it still is a little surreal. The run, the loss to Michigan, and yeah, everything that followed. Ryan Day, his kids were getting heckled in like fourth grade class. They had to remove him from school, and now he could probably run against Vivek for governor of Ohio if he wanted to. So how the tides turn. So
Well, if you guys have me on again sometime, I'll have you won't be subjected to that terrible headshot that got sent out of mine. I've had for the last few years. It kind of on the invitation you sent out, it's got my headshot on it. So Alex Rich just sent me the new one that I had taken down at the TMC conference on
okay.
Monday. When she sent it, she said, "By the way, Chris, don't worry. I can use AI and really kind of tighten this up and make it look a lot better." I'm thinking, wow, that makes me feel pretty great. I feel like saying, "Do you see what my current one is? It's kind of some weird cross between one of those bobbleheads from a Major League Baseball game and like the caricature of Beavis and Butthead from the 90s on MTV. So there's really only one direction we can go, hopefully, and that's up. So hopefully, if you guys have me on again, I'll have a better headshot to include there.
AI, you gotta love AI. There you go. All right, well, let's go ahead and get into it. This is the big picture presented by our friends and sponsors at Depth. 20 years of ably serving the mortgage and fintech industry so well. Carrie Milam, Leslie, Lindsay. If you're not working with Depth, why? They're phenomenal. They do great work, as Chris Bennett can attest.
We've used them for 6 years. They're absolutely outstanding. Just they know the mortgage business like the back of their hands.
So check them out at depthpr.com. And Rob, on cue, your hand was up. You have a question? Or?
well, you said you let off by saying, let's get into it. And I thought we were already getting into it, talking about Chris's mugshot. And I wasn't going to even bring that up, Chris. And I looked at it, and I was with my son Robbie, and he was looking at it, and I was looking at it, and I was trying to be tactful on today's call. But since you brought it up, um, actually, it's a fun little character, right?
Thank you. Yeah, gotta have some fun with
We'll
yourself.
leave it at that.
Right.
We'll leave it at that.
All right. Well, Rob, the news cycle continues to be very vibrant in the mortgage industry these days. And of course, yesterday, the conclusion of the latest Fed meeting, which was followed by President Trump tweeting that the Fed would be much better off lowering rates. So a not so subtle nudge to the Fed to, in his words, support the economy through the tariff transition. Also of note, I found this incredibly amusing yesterday that Jay Powell, who continues to just sound really lost and clueless, he said that the impact of the tariffs would be transitory. Just a questionable choice of words. Maybe somebody should introduce JPod at thesaurus.com. No, maybe a better word could have been used there. But Rob, as always, I welcome your sage advice on all the latest happenings in the mortgage world.
Sage advice. Well, wear sunscreen. Buy low, sell high.
There you go. Water stocks.
And when you talk about, I don't know the political makeup of the listeners, viewers, nor does it matter. Uh, but the fact of the matter is, every president wants lower rates. So, Rich, let's say you and I were on a train traveling somewhere, all right? And I had a little rubber mallet and I was tapping you on the side of the head. I was just tap, 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 tap. And then finally I stopped and I said, "Don't you feel better now, Rich?" And you said, "Yeah, I do feel better now." I didn't have to be tapping you on the side of the head, right? But I was. And then when I stopped, it's like, "Oh, Rich, why don't you thank me for that?" You would be puzzled by that. So if a president, in this case Donald Trump, is doing things that will slow the economy, and we knew going into his presidential administration that he, is focused on tariffs. I don't know why so much focused on Canada, whole different topic, but focused on tariffs. Tariffs don't stimulate the economy initially. And the thinking is like, I've heard a couple stories, one involving fentanyl. We want them to take, Mexico and Canada take a harder stand on fentanyl. And then the second thing is the more tariffs we put in place, the more manufacturing jobs will be put into the United States. Well, it takes a long time to build a car manufacturing plant, first off. Um, and I don't know how much, I'm not an expert on how much drug, trafficking there is, but tariffs will slow things down. And for the president to say, well, the Federal Reserve should lower rates because of the tariffs that I'm putting in place, it's kind of going back to me hitting you and then asking for your thanks when I stop. The president, if he wasn't doing this, and we knew that he would, but if he wasn't doing this, then the economy might not need lower rates. And in fact, uh, I continue to say this, Rich, I sound like a broken drum, but the economy, from my perspective, from my limited view, going to Denny's at 4 o'clock in the afternoon for the Grand Slam senior citizens dinner and that kind of stuff, or looking in the airport parking lots. I mean, the economy's not doing bad. It's not doing bad to the point where we need lower rates, nor is it going gangbusters to the point where the Fed needs to raise rates to slow things down. I think the Fed was, I think I'm more of a Jerome Powell fan than you are. I wouldn't even call myself a fan. I think that, given the information, he's doing what he can, and all the Fed governors and the presidents do what they can. But the economy is what it is, and let's leave rates alone. And that's indeed what the Federal Open Market Committee did yesterday. And on we go. I've been telling people for a while, if you like rates where they are, good, because I think we could be here for a while. I don't see a big move down or a big move up. And in fact, lenders out there and originators and brokers and so on have other things to worry about other than interest rates. Interest rates impact affordability, but let's not forget homeowners insurance costs. Let's not forget lack of inventory. Let's not forget millions of millennials who would like that starter home. Let's not forget the lag that we've seen in the builder segment of our industry for years, not building enough homes in certain areas. So there's a lot of things going on. Interest rates are only part of the equation. Um, that's my 2 cents. I'll stop rambling. Chris, what do you think?
I think in his presser, I like you're right. There are not a whole lot of presidents that ever in history say, I really want to. The Fed really needs to raise rates. We need to slow things down. So yeah, you're right. That happens all the time. Actually, who was it? Nixon with it was either Arthur Burns or his predecessor back in the 70s, literally physically shoved the chairman of the Fed around in the Oval Office. Now back then, of course, he was talking about raising rates up to 15%. So different story than right now. But yeah, the whole idea that the president wants to come out and have a say and get rates to be lowered a little bit, get things to be eased. That's nothing new on whatever side of the political spectrum it is. What I thought was interesting about, when Powell gave his talk afterwards, and we're all used to how monotone that talk is. It's not the most exciting talk in the world, but they didn't do a whole lot. And he kind of said, "We've got the economy is just fine. We've got the luxury of waiting. There's a whole lot of uncertainty out there. There's a lot of uncertainty by consumers, by the market, and part of this is this kind of." Had a little bit of incessant chaos kind of going on right now, right? Not the more well thought out chaos about tariffs which isn't actually chaos, but the more well thought out practice of, hey, I'm going to commission the chair of this to spend 60 days, research what tariffs are charged on us, and have talks about it. And we're going to decide, give me a recommendation, and we're going to have reciprocal tariffs. So maybe these countries want to reduce their tariffs on us so they don't get put up on them. That's a lot more well thought out and a lot easier, I think, for the markets to digest than these ones that just come out via tweet. 25%. Are you getting 50? Oh yeah, well now we're going to get 200 on our wine that we get from Europe. Those things markets don't like that kind of instability. And that's certainly one reason that gives the Fed pause of saying we need to wait to see what happens here. And you're right, of all the choices to use transitory. And when he was asking about that, he said, well, yes, I know transitory didn't play out the way we wanted to post-pandemic. But if you look at the tariffs, this is not our first rodeo, of course, with President Trump. In 2018, we had a round of tariffs, maybe not this big, but we had a round of tariffs, and there was a slight uptick in inflation. But again, it was transitory. We actually didn't see broad-based increases in price levels. So the Fed can afford to wait and see what the effects of this are. What effect is it going to have on consumer behavior and consumer sentiment? So I think they're probably.
I would think, Chris, I would say the Fed has little choice other than to kind of sit a little bit here and see what might happen. I mean, you just don't know with this administration what's going to happen overnight. What tweet is going, what tariff is going to be put in place and then taken off the next day. Rich, I thought you were going to ask me about the Doge bro put on the Fannie Mae board, and then he resigned today. Put on yesterday, resigned today. I thought you were going to ask me about that. Speaking of transitory,
I think once people saw the picture of that guy, they're like, "Listen, we got to get this guy off. Listen, this guy looks terrifying. Like this, you cannot put this guy in the Fannie Mae board. I don't care what the hell he's done for X."
Yeah,
we never formally introduced our guest this week. My mistake. But welcome back. Since we rebranded and relaunched the show as The Big Picture, the first 3-time returning guest show. The first is our good friend, the principal and founder, Vice Capital Markets, an incredible hedge advisory firm that services mortgage lenders across America. It's our friend Chris Bennett. So, Chris, sorry for no.
Hey, not at all. This is all about life and levity, right? We always really appreciate you guys having me on. It's a real treat. By the way, so yeah, this is 3. If I'm asked on 2 more times the next year or 2, do I get, like on Saturday Night Live, like one of those velvet robes that I can wear for the show?
You get a Ohio State tchotchke.
Chrisman LLC will be shipping you a Rolex after you execute your 5th show. So
there we go. I like it.
So, and
there's always no shortage of great stuff to talk about with you guys, especially whether it's capital markets things and the Federal Reserve or all sorts of other stuff going on mortgage land or just life in general. There's no shortage of things to talk about with you too.
Yeah, and there's been, especially right now, there's just so much going on. It is kind of crazy and chaotic as we, I will still make the argument that like something needed to be done. And maybe this is too aggressive, too violent, but this cycle, I know, Rob, the economy's doing great, but that is in really stark comparison to what the majority of Americans feel based on poll after poll, the results of the election. This lingering inflation is just beating people down, credit card balances, the price of housing. So it really, I get it. And the markets do hate this uncertainty. They hate what's going on right now. But, at least to me, executing the same playbook. To me, it was a losing playbook, both from the White House and the Fed. And, I do think something needs done. And you could
So
argue,
Rich,
you know,
Rich, let me interrupt. And I'm being rude here. So
Mhm.
if you were Jerome Powell, would you lower rates?
If I was Jerome Powell, I would resign. I think he's,
Okay.
I
So
mean,
so
why would you want to be in that position, number one?
tell us
With
how you really feel.
somebody just constantly second guessing you via tweets. And two, he's just, I know you think he's done a good job. That's a hard
Yeah,
argument
well,
to make.
I think that he's done the job that he can do given the presidents that he's been under. And given the pandemic, I mean, who knew what was going to happen with the pandemic, right? And now you have people saying, well, I knew that it wouldn't, kill the world off, and I knew this and I knew that. Well, you really didn't know. We really didn't know. And yeah, the Fed, I freely admit the Fed kept rates too low or push rates too low for too long. And we're paying the price for that. And certainly we had, 3 or 4 or 5 years of production crammed into 2 years in terms of mortgage originations. And now we are dealing with a bunch of people with 3% or 2.75% of mortgages. So yeah, that was a mistake. Um, but now, I mean, Jerome Powell, first of all, he's not going to resign. Second of all, you're right. I think Donald Trump would be very, very difficult to work under. And I've read books by people who have been in the White House and worked under him, and every nightmare you could think of is true in terms of just the changes and what happens behind closed doors. So it's a tough spot. Jerome Powell, I don't know. We wouldn't want somebody with no experience in that post. And people will say, well, Jerome Powell's an attorney. He's not an economist. Well, we had a Fannie Mae Nobel economist on the board who was kicked off the board. Let's put him in that role. I don't know. Now I'm just ranting. Sorry.
The
I'll
good news is
stop.
they all have teams of economists with more research than you can possibly even know how to deal with that can really help make those decisions. So that's at least the good part of it. And I don't know if does Chairman Powell work for President Trump? I don't know. If you work for somebody, usually you're fireable, and he's not fireable. I see him as being somebody who he wants to just nose down, nose to the grindstone, do his job. He cares about his legacy like most people do. Just wants to do a great job, and I think he's just kind of, especially he's learned after he was appointed by Trump. Obviously, he's learned to just ignore the noise, to realize that the things that come out of the Beltway in Washington D.C. There's a lot of politics involved. There always is, and to just ignore it and go about doing the best job he can, so that when this is all said and done, hopefully for his sake, he can be lauded as having got us through, the pandemic things, terrible inflation, and he can go back to a nice life of getting paid $25,000 or $50,000 a speech for the rest of his career. That's not a bad gig.
Jeff had an interesting comment about Paul Krugman winning the Nobel Prize and being wrong all the time anyway. Yeah, the jokes about economists are there for a reason. You know, Harry Truman saying, give me an economist with, one arm or something. Anyway, all right, enough.
I'd be shocked if he is still in the role by June. And my big thing is I just think we need a fresh approach. The data that they're using to me is completely antiquated. And I just think in this day and age of AI and ways to obtain real-time data, that we are using data from months ago to make decisions, and we're off by 1 million jobs. 1 million? Like, how is that possible? How can we have a revision that, oh, sorry, there's 1 million less jobs we created than we thought? Like, that is really alarming to me. And when I hear him speak, every time I get less and less confident. But we'll see. I mean, I get it that the job is not easy, and you can't just put some MIT data nerd in there. But yeah,
Rich,
your
Rich,
thought.
I'll bet you an adult beverage. And we have, lots of people as my witness. I'll bet you an adult beverage at the next event that we are at together after June,
Okay.
that Jerome Powell is not gone by the end of June.
Okay. Let's make that. That's an official bet. All right.
Is it a beer? Is it a Zima? Is it a specific adult beverage, or can the loser choose?
It probably involves hard alcohol. Depends how badly I have the shakes, Chris.
One thing that I thought was really interesting in what the Fed came out and said is, they changed the summary of economic projections, right? Every 3 months. And given all the things that have transpired since last December, there have been a lot of things that have transpired, right? The changes they made were really very subtle. It was revising the GDP estimate for the year from 2.1 to 1.7. It's taking the PCE expectation, the inflation expectations from, I think it was 2.5 to 2.7. And right after that, there were a couple of, talking heads on news media that were saying, oh, yep, so it looks like the Fed's calling for stagflation. I'm thinking to myself, that's not stagflation. That's tweaking numbers by actually very small amounts, given a lot of things that are happening. I don't know if it pays to be dramatic if you want to be asked back on news shows. Maybe I'd get on Bloomberg and CNBC if I was more dramatic. I'm not sure. But really, for all the big things that are happening, the critical core assumptions for 2025 weren't changed a heck of a lot by the Fed. So I thought that would be a good thing. There's a lot of, when you look at those surveys, right, whether it's the New York Fed, one of their surveys asks all consumers, what are your expectations for inflation in a year, 3 years, and 5 years? And those expectations are all 3%, 3%, and 3%, literally 3.0 on the dot. And it's been that way for probably 6 months or so. So there wasn't this huge surge overall in those expectations. Another one that comes out that's been around for a long time is the University of Michigan survey. It's consumer sentiment, it's inflation expectations. These are, these kind of numbers come in and out of favor depending on what kind of cycle that we're in. And right now they matter a lot, where for 10 years, no one cared about them. And one of the things I found really, really interesting about this wasn't just the core number of what do people think are their inflation expectations, which did tick up over the last 2 months, but the difference between the inflation expectations of Democrats versus Republicans. Because part of their surveys, they say, are you a Democrat, Republican, or independent, or prefer not to say? And if you look at, and there's a huge gap in those expectations right now. If you look back at the entire Biden presidency, there was about a 2 percentage point gap between Democrats and Republicans the whole time. You had a case where, on average, Democrats thought we would only have 1.5% inflation, maybe 2%. Republicans during the Biden administration thought it would be more along 5%. And really, it was kind of, there was a big part of it where Republicans were expecting basically what the CPI was at that time. It was very market-based, and Democrats always expected it was going to moderate, and Joe Biden would make things come back down. And then as soon as the election happened, those completely flipped, not only flipped, but got even more exaggerated. If you look at that breakdown right now, on average, the Democrats surveyed expected 5.5% inflation over the next year. The Republicans surveyed expected 0.0% inflation in the next 12 months. So that's a huge dichotomy in expectations, right? And I think it goes to, it isn't just that each group only gets information from one source and they hate the person in the White House or they love the person in the White House, but they're looking at things from different perspectives. I think the average Democrat is looking at, we're having all these tariffs. Tariffs have costs, and that's going to be very inflationary. And other things that are costs aren't just tariffs. Regulations are costs that, like tariffs, most of which get passed on to the consumer. So the average Republican is looking at the New Deal and saying, hey, we're going to work to lower regulation, which lowers costs. We're going to try to, by lowering regulation and lowering some of these other restrictions, produce more oil, lower the price of oil. Try to do other things that help to stabilize and lower prices. And so it's not because each side is drinking the Kool-Aid of whatever shows they watch, but that's the lens through which they're looking at things. And I think what that says to us, though, is that we've got this real dichotomy, and businesses don't necessarily operate that way, and markets don't operate that way. If you look at what the market thinks about inflation expectations, it's, as you might expect, somewhere in the middle. But it shows how those consumer behaviors might be very, very different now than they were a year ago, 2 years ago, and 3 years ago. You've got one group that's expecting terrible things, and one group that's expecting great things to come. And we're going to see very different behaviors out of consumers because of that huge dichotomy, I guess, in expectations.
And a couple good things in the chat. Rob, your heckler, of course, is back, questioning that you're not an expert in drug trafficking. He says to ask the airport drug dogs. So that's in the Q&A. And then a good question in the chat. What about the reductions in the runoff, Fed balance sheet, MBS? Not buying anymore. What does this indicate about liquidity expectations, Chris?
Yeah, I think it's indicative of the Fed being a little concerned that we could have some liquidity issues down the road, like we had back in 2019. So they called it a technical adjustment. I think that's probably a good term for it. I think they want to make sure that they don't need to tighten quite as much, especially from the Treasury side of things. I think they're taking from 25 billion to 5 billion a month, so kind of nothing. So I think kind of just making sure that, especially during this time period where we've got more volatility going on, where we've got more widely changing and wildly changing sometimes expectations, they want to make sure they've got the ability to provide enough liquidity there. So it seems like a smart call to me. Again, they call it a technical adjustment, but it seems like the right call.
And then, Chris, just general like MBS demand, these 6.5% and 77% Fannie and Freddie securities. I guess the demand for, American mortgage debt right now, there's not a ton of it. Volume is limited, but I mean, is demand still strong for American mortgage debt as it relates to like treasuries or?
Yeah, there's been a couple interesting, back when, in 2022, when we had such a shock, right? We went from, mortgage, doing Fannie threes to suddenly Fannie sixes in a matter of only a few months. It really did a number on liquidity because all of the mortgage-backed securities that were out there were all things at prices of 85 and 88 and 90 now. We're not making any more of those. There's a ton of them out there, but because we made such a sudden shift up to things like 5% and 6% and 7%, we hadn't had enough time to make any of those to create some liquidity in those coupon structures that we really needed. And it was going to take a long while, especially in a slow housing market, to generate that. And every month it's gotten better. Every quarter it's gotten better, very, very slowly at the margins, where now we have a much, much better functioning mortgage-backed securities market. It's hard to know what something should be worth when you don't have any history behind it, right? When all the 6.5s that we'd had in the past all refinanced back in 2020 and 2021. So that problem's really solving itself. The markets, it does sometimes exist in fits and starts, and there'll be some shorts out there. We had one last month where there were a couple high coupons where they made a big CMO made up of mortgages, and they didn't have enough mortgages, backed securities to stick in there. So there's some disconnects there, but it's a lot better than it was before. Also, there's been a really nice trend upward in the amount of mortgage-backed securities that are being purchased by banks and other depositories to put on their balance sheet. So even though the Fed hasn't been a participant and it's been running off and not at the full amount of $35 billion a month they want, but banks have stepped up in there in addition to other folks that, retirement funds, pension funds, municipalities, all the people that like to invest in nice things that yield 5.5% and are backed by the government. There's been a really nice increase in participation from especially banks in the mortgage-backed security space that is really helping to support that market too. So good things to see. Private label securities too. It's a lot better functioning market than it was a year ago and 2 years ago. There's a lot more folks coming to market, a lot more securities out there. And the more that we have, especially at these yield levels, the more of a track record they have, right? When you're trying to decide, do I want to buy this tranche of this thing? Do I want to buy this? It's helpful to know, here's how it's performed last year. Here's how it's performed the year before. And when, again, you have that sudden shock from 3% to 6%, you have no idea, A, when's the Fed going to stop tightening, right? And now, of course, that happened a year and a half ago. But B, how can I expect this new thing I want to buy to perform when I have no record of it all? So time heals all those things, and time's been healing that a lot in the last 24 months.
This is The Big Picture, presented by our friends and sponsors at Depth. I'm Rich Swerbinsky with Onward and Upward Consulting, joined as always my esteemed colleague and co-host Rob Krisman, and this week back for his third appearance, the first three-timer. It is our good friend, the principal and founder of Vice Capital Markets, Chris Bennett. Something I'd like to get both your thoughts on, Rob, and I'll start with you, is just over the course of the last few years, we've seen what are the big drivers of mortgage rates? I think there's been periods of time, and certainly inflation is always, in that mix and has been at the top of the heap. But there's been times where the Fed has really, really been looking at jobs data, maybe Treasury yields, other things. What, Rob, is, like the critical like driver of the up and down of mortgage rates right now, in your opinion, to like the LO that's listening in the audience that's trying to explain this to like a pre-approved, wannabe home buyer?
Well, I don't think it's really changed other than, um, I'll put on my way back hat here. When I first got in the business, everybody was looking at money supply, which came out Thursday afternoons, and that would drive the market. And then we gradually transitioned to unemployment on, jobless claims on Thursday mornings and unemployment on the first Friday of every month. And then in recent years, it's been more what will that piece of news do to the Fed's thinking? And I remind people time and time and time and time again, the Federal Reserve does not set mortgage rates. Mortgage rates are set by supply and demand. I don't recall that ever having changed. The question then becomes, well, what impacts supply and what impacts demand? And we've seen supply diminish. We saw supply pick way up in 2020 and 2021. At some point, we will stop talking about things that were going on 4 or 5 years ago, I hope. Uh, the we have the private label market, private label securities. People still think about March of 2020 when the non-QM investors backed out of the market almost entirely, or at least backed their pricing off. And so that still is in the back of people's minds when you talk about non-QM rates. But non-QM rates have come down because prices of securities have gone up. The market is more accustomed to non-QM/private label securities, and so are more comfortable buying them, especially with the ability to repay and some of the appraisal mechanisms that we have in place to ensure that the property values are what people say they are. In terms of the Fannie Mae, Freddie Mac sector or FHA, VA, it's still supply and demand. The demand is strong. Um, and the supply has come down quite a bit in the last 4 or 5 years. And it's, the NBA thinks, we'll do $1 trillion or so this year. A lot of people say maybe, maybe not, depends on what rates do in general. But the supply is relatively steady, and the demand is good. And while I'm talking about the demand, I think, and this is a message that I've continued to try to hammer home as well, the the feeling that, oh my gosh, we've got a new administration, the CFPB is defanged or declawed or at least put on the back burner, and uh, gosh, can we do away with fair lending? Can we do away with RESPA? Can we do away with TILA? Can we do away with ability to repay? Can we do away with the new 1003? Can we just go, can we put point banks in? Can we, blah, 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 blah. I hear those questions from the rank and file, the originators. I don't hear them, fortunately, from the owners of companies or the senior management teams of companies. I would say the senior management of companies are saying, you know what, regardless of what happens with the CFPB, many of the rules and regulations we had in place were put in place before the CFPB came along. Second of all, a lot of them are there to help the borrower. We're not going to do away with those things. But what I'm trying to remind people is when you talk about the demand for mortgages, whether it's in a portfolio or mortgage-backed security, many of the rules and regulations that we have in place now give capital markets, secondary marketing investors, mortgage investors, peace of mind that when they buy a pool of $500 million of FHA loans or of Fannie Mae, Freddie Mac loans, that the appraisals are done correctly, the borrowers have the ability to repay, the borrowers weren't steered, that the pool is filled with good loans. And when you talk to any originator now, talking about credit, and the ability to repay, they will inevitably say the book of business that's out there now is filled to the brim with borrowers who are making their payments, who have the ability to repay, that the values are there, and so forth and so on. So the demand for our mortgage-backed securities is very strong, and the demand for mortgages in portfolios is very strong. If we get to a point where Fannie Mae and Freddie Mac or FHA, things are happening whether it's out of Washington, D.C. or whatever, that impacts that demand for mortgages by investors. That's where I think we'll see a big problem.
And Chris, are we in a spot now, because of the tariff stuff and, the recession speculation and, the is Trump trying to break the economy talk? Like if we get a bad inflation number, normally that's bad for mortgage rates. But could it actually, we get in one of these cycles where it maybe actually could be good for mortgage rates because of the expectation of recession and more
Isn't
aggressive?
that stagflation?
I mean, I guess I'm asking the
If
question
it
in a
comes to it,
way.
yeah, I think one of the interesting things, Rich, about the CPI, which has always been the big focus, the Fed's, big thing that they really look at is PCE. And so now every time CPI comes out, and this happened this month, they don't look necessarily anymore at the headline number and the core number. They look at the components and say, ooh, what does this tell us about what PCE will be? And we got a CPI number that wasn't necessarily all that good. But when you dissected it and you looked at what PCE would be, you said, oh, that's actually going to work out pretty decent. So that part's really interesting. And PC, for a lot of people that, 85% of people don't know the difference between CPI and PCE, personal consumption expenditures. CPI says, here's my basket of goods. What did it cost last month and last year? What does it cost now? Price of eggs is a great example, right? Let's say the price of eggs has doubled over the last year. So that increases CPI because eggs doubled. PCE says, well, the price of eggs doubled, but because of that, the demand for eggs will be reduced by 40%, and 40% of the people will substitute instead waffles, pancakes, and English muffins for eggs. And those prices didn't change. So while CPI shows the price of eggs doubled, PCE will have a much more muted impact because consumers can substitute goods. If the price of pork chops goes up a ton, people might substitute turkey or chicken, those kinds of things. So CPI often will run a little higher than PCE, and PCE is really what the Fed focuses on. But I think, Rich, to your point about, and Rob, you're talking about, well, if this happens, is it stagflation? I think there's a lot of different headwinds and tailwinds that are going to be coming at us this year and next year that all have to be kind of evaluated. You've got headwinds and tailwinds that have to do with what are the effects that tariffs have on inflation? What are the effects that tariffs have on economic growth? What are the effects that changes in regulation have on the ability for companies to lower costs because their costs are being lowered? And how does that help reduce inflation? There's a lot of different things that can happen that all have different effects on inflation and different effects on growth. And so it really kind of comes down to seeing what the results are and finding out which of those effects were stronger effects and which of them were weaker effects. The Fed has this dual mandate, right? Their dual mandate is for full employment, and at 4.1%, that's unemployment. That's full employment. It's full employment and price stability. We're not at 2%. We haven't been at 2% for 3 years or so. So the Fed wants to get there, but if we start to see unemployment tick up to 4.5, 4.6, now they have to weigh the dual mandate and say, all right, do we need to ease because one side is becoming unbalanced relative to the other side of it?
The Fed folks should remember, the Federal Reserve only has so much impact on the rate of inflation. The Fed can say we want a target of whatever percent, but then, as I'm fond of saying, there's a drought in Ghana, so the cocoa supply gets cut in half, so my chocolate bar price goes skyrocket. Bird flu, shortage of eggs, ship stuck in the Suez Canal, a drought in Kansas, impacts the wheat crop, and those things impact inflation. The Fed can only do so much, and then when you throw tariffs on top of it, it's like a man-made, potential inflationary impact. That further complicates things. So it's a very, the future is always uncertain, but I would say that it's especially uncertain now.
On top of all this, we've got a bunch of stuff just going on in the world: Russia, Ukraine, the Middle East, just general tensions between the U.S. and China, and to a lesser degree, our neighbors to the north and the south now.
Yeah, let's talk about the tensions between the United States and Canada.
It's
Anyway, we shouldn't go there right now.
But yeah, I guess where I was going with that is, Chris, I'll start with you on this one. Is there you know, anything in the geopolitical arena that, you know, just people should be keeping an eye on that, you know, I mean, typically geopolitical tensions, people flock to the safety and security of fixed income,
Mhm.
treasuries, mortgage-backed
or
securities,
gold.
gold,
Yeah, right.
precious
Bring three
metals.
thousand
But
dollars an ounce.
I mean, is there anything like Chris, like that could happen geopolitically that could have big impact? Is there certain things that maybe those of us in the industry that are watching should, you know, just keep an eye on that could have big impact if it breaks one way or the other?
I guess it could be everything, right?
Yeah.
You actually just named like 7 different things that could happen out there, right? And Rob named another 7 that have happened.
Mhm.
So it's really hard to say, right? There's a number of things. You know, if there's a true truce and an end to the war between Russia and Ukraine, is that beneficial? It sure is. You know, that creates a lot of supply issues. That creates it helped. It was one of the bigger things that had to do with the big surge in inflation that we saw all over Europe, all over the U.S. Maybe I don't know if it was half of it, but it was at least a third of it. It was pretty big. So those things matter a lot. Is there one particular thing to keep in mind? I don't know. You know, one of those kind of headwinds and tailwinds is, you know, tariffs are taxes, right? But to the extent that they help reduce our deficit, you know, budget deficit, is that helpful for bonds? Is that helpful for mortgages? You know, that's something that also could help benefit us. You know, right now we're going to run a deficit. I think we're on pace for at least $2.5 trillion this year. That's a lot. So, you know, is it great to do it with a chainsaw and kind of chaotic? Probably not. But, you know, does the federal size of the federal government need to be trimmed? It probably does. You know, the more things that can be done by the private sector instead of government, and obviously we can't have private militias, we need to have the military, but the more things that can be done by the private sector, the more efficiently they can be done. It seems like government never seems to contract. It always seems to only expand. So that's something that could be a positive headwind for us too. It's really kind of, to my mind, it's hard to look and say, hey, if you look at how the situation in this part of the world is going to work out, that's going to have a big influence on what's going to happen, especially to rates. I don't know what kind of one particular thing to point your finger at. I think it is a good thing that if you look in the last 2 months, while certainly there's been heavy volatility in the equity markets, given the things that have been happening and potentially happening, the bond markets themselves, I feel like have been really relatively calm. We haven't had nearly the volatility that I would expect given the cross currents that we're seeing in the equity markets from all the uncertainty that's been out there right now.
You know, Chris, one of the things we haven't really touched upon, which is really difficult to touch upon, is the psychological impact of all of this going on, you know, I mean, we're a mortgage show here. You know, what is the psychological impact on borrowers of tariffs or putting tariffs in place, then taking them off, or what's going on with Canada, or what's going on with the price of gold, or what's going on with China, or what's going on here, there, and everywhere. I mean, psychologically, people tend to hunker down. They tend to, you know, if there's a lot going on, they just kind of they hunker down, for lack of a better term. And so that also impacts, you know, our business. You know, are we going to hit 1 trillion or 2 trillion or whatever it is? Part of that is what's going on psychologically with potential clients, potential home buyers.
Yep, I agree 100%. I think if you look at the overall consumer sentiment numbers, they're dropping, right? Because of the uncertainty. Even though consumer sentiment among Republicans is up substantially over the last 3 months, among Democrats, it's down substantially over the last 3 months. The overall is a little down just because of that, like you talked about, the uncertainty factor. Does that, you know, I don't know to what extent are there a lot of people who, especially as the weeks have gone by, have started to tune it out more and more. We've kind of lost the shock effect that maybe we had for those first few weeks. You know, how many people have the idea of, hey, you know what? I don't watch a whole lot of national news. I'm sick of seeing it. Really, I care about our kids are getting older, and I want to move to this new school district, and we want a bigger yard and a bigger fence, and that's why we're making our decision. And we're not, you know, maybe there's a number of people where we read into it more than the average home buyer is, who's just kind of looking at what's best for my family and what do we want to do with our lives. And despite all the things that might be swirling around the world and how they might shake out, which I, as a consumer, can't really do much of anything about.
Yeah, it'll be, you know, it's always interesting. I always try to put myself in the place of a first-time home buyer or somebody just starting a family, or what might be going through their head when, they hear this news. And you're right. I mean, at some point, if you're in an apartment and you have a kid, and another one's on the way, yeah, you want to buy a house regardless of interest rates. We saw that going on in the 1970s and 80s when rates were, in the teens. People needed a home over their a roof over their head. Um, Now, I would say it's the same thing is happening, but they are confronted with, lack of inventory and higher rates and higher homeowners insurance costs and so on. Um, it's yeah, always interesting. And we're out of time.
Bill Pulte being made director of FHFA, it kind of can't help but be a good thing for our industry and for homeowners in general, don't you think?
One would hope.
I would hope so too.
Yeah, I mean, I gotta admit, I have not like just hearing him speak. I haven't been impressed, overly wowed, but I do like the fact that he is from a home builder background, and I am now in the camp that really does feel like the GSEs do need to be privatized.
It's
And
going to take it's going to take a long time. It's going to
yeah,
take a long time.
and I think that's the way it has to be done, to do it right.
Right.
Which we've heard Scott Besson say.
Yeah.
So
It's not, there's a dichotomy, Rich, out there, I think, of you got Elon Musk doing the slash and burn, and now you got Bill Pulte, who, by the way, is a large stockholder in X. Um, Bill Pulte coming in and, getting rid of portions of the board of Fannie Mae and Freddie Mac and putting in other people, which may or may not have a positive or negative impact on the GSEs. Certainly, you have people out there saying, well, it's time for new blood and do away with these people and bring in somebody in their 30s. Although that backfired today or yesterday and today with this guy, Christopher Stanley. But, we'll see. I mean, certainly he understands the business.
Yep.
I mean, you had the Fed chair himself yesterday say, like, I don't think anybody's confident in their projections. It's just a really tough time to kind of project. I mean, I've been cap markets guy, was how all of us had our upbringing, and just been watching the interest rate and mortgage bond markets my whole life. And it's just naturally, it's just so tough right now. So naturally, I'm going to close the show by asking you guys for your rate projections here. And any thoughts on how this year plays out? Rob, I'll start with you. I know how much you love rate projections. So,
Oh, I think we'll be right here.
do you think it's just going to kind of high sixes ish, just kind of some up and down, but we'll just kind of be here? Chris?
I'm also the same way, but it's kind of it's funny. You almost have to look at it like, or at least the way I'd have to look at it, since I can't predict the future, right? Is if you're in sports betting, the book sets the over/under, right? The Rams are favored by 3 points. Well, the Rams quarterback just got hurt, so now the Rams are underdogs by 2 points. It's a setting of, here's my baseline median expectations of what should happen, and this could happen up here. The Rams could throw 6 touchdowns. The Rams could throw 3 interceptions. We don't know what that's going to work out to be. But if you go with saying the Federal Reserve has the best information there is and very smart people analyzing it, and here's what they project, if those come to pass, and we see, they talked about, hey, the dot plots still show 2 rate cuts in 2025. That's only partially true. I think it's 8 out of the 19 Fed governors actually were projecting 0 or 1. So the median is 2, but it's only the median by 1 voter. So call it 1 or 2, call it 2 the next year. In the end, the 5-year Treasury is what? Around 4%. Mortgages are going to closely follow the 5-year Treasury because mortgages last 5 years on average. So if that ends up dropping as a result at the end of next year to, say, 3.5, maybe 3.25, but 3.5, that's only mortgage rates coming down about 50 basis points from their current level, maybe 75 basis points if we can get a little bit of relief on guarantee fees, but I wouldn't count on it. So on average, what should we see? I'd say by the end of next year, we should see 50 basis points lower, maybe 75 at the outset. But again, that's just got to be a baseline assumption. That's the line, set by Vegas, because none of us know what's going to happen out there. None of us know what are going to be the effects of the cross currents of tariffs and lowering regulations and how will that affect output? We just don't know, right? But I think one of the bottom lines is, and Rob, you're really good at saying this all the time, is quit worrying about it so much. In the end, it's people have too often the idea that, oh, things are terrible. There's no refinances. If you think there's no refinances, you're missing out on the 30 or 40% of refinances that actually are there. That means other people are refinancing your borrowers. So if you think there's no refinances, you're missing the boat, right? Or the housing market stinks. The housing market doesn't stink. The housing market's lower than its 10 or 15-year average, sure, but it's better than last year and it's better than the year before then. This is a normal-ish time frame that we're in. And if we, maybe rates are up 1% higher than a longer run average, and yeah, we've got this big block that's been locked up at 2% from this extraordinary time, but this is what we're going to be living with. So if you're not making money in this environment, you better figure it out really quick or find something else to do, because other people are making money. You just need to figure out what you're not doing right, that you're not actually joining that. It's not enough to just meet the average. You got to find out how you're going to perform and how you're going to succeed, because this is what we're going to be in for a while.
I love it.
These are the good old days.
And last thing, I mean, there's no chance of reductions in LLPAs or G fees, right? With them steering towards privatization. I mean, it's accumulate capital, right? And I mean, I can't see any chance that your LLPAs and G fees are lowered at all, right? Is that, Chris, what would you put the percent chance of that happening?
Well, I'd sure love it if they were, because they're egregious compared to the actual cost.
Right, I agree, but yeah, but
yes, used to be the average guarantee fee was about 20 basis points and there were no LLPA, right? Now it's 50 basis points and you could add another, by the time you convert the LLPA on average to rate, it's 75. So it's a huge, big fat chunk, right? But where's the incentive? If FHFA were to ever say, under Mr. Bill Pulte's leadership, that, hey, we need to lower interest rates for consumers to help spur the housing market to get houses changing hands, that's great, and we'd all be all for it, right? But like you said, when we're in an environment where Fannie and Freddie are trying to stockpile money to potentially go private, it's hard to see that happening, unfortunately.
Well, good stuff, and a great show. Thanks to everybody for all the nice comments in the chat. And Chris, yeah, always love having you on. And per usual, we'll put another date on the board. Love to get you in here quarterly. Just everybody always enjoys your perspective on the markets, and I really appreciate you making time to come on the show.
I really appreciate you too having me. I really enjoyed it. I loved everybody's comments too. I'm getting better at being able to multitask and read them as we're talking too.
It was good. The comments continue to filter in. And Rob, as always, great seeing you, and great discussion today. And where are you headed next? Where your next travel is sending you?
Yeah, I'm going to MCT event end of next week, where I moderate a panel with Fannie Mae and Freddie Mac folks.
Oh, okay. All right. There you go.
I'm sure loan level price adjustments will be asked about and then not answered. So anyway,
don't tell them I said they were greedy.
Yeah. And thanks to depth. Thanks to depth.
Thank you to our friends and partners at depthpr.com. And most importantly, thank you to those of you that take time out to consume this show every Thursday. We're live at 3 p.m. Eastern. You can go to chrismancommentary.com to get signed up. One-time sign up for all the live shows going forward. And of course, this goes right to pod and YouTube shortly after we conclude here in a second. So
and Chris, sorry about mentioning MCT, but Rich
that's okay. Friendly competitors.
Well, good stuff. And until next Thursday, have a great rest of the week and weekend, everyone. We'll see you next Thursday at 3 Eastern. Have a great night, everyone. Take care.
Everybody.